Today we are going to break down each country where a person can legally pay no taxes and how it must be done in each case. This will not be a short video because when we talk about tax residencies, maybe Paraguay is very easy, maybe the UAE is very easy, maybe Cyprus, Andorra, but what structure do we need to establish in these countries to avoid taxes or to pay no taxes? I have seen many comments saying that Europe is done, that I should only recommend countries outside of it. And well, we already know that Europe, specifically the European Union, is undergoing brutal decline, but there are still a few hidden gems where we can take advantage of low taxation. Not zero and abroad like in other countries, but still considerable. As I explained in another video, we have Cyprus, Malta, Portugal, Andorra, Bulgaria, Romania, Albania, UK, Monaco, Switzerland, Luxembourg, Estonia and Georgia. Starting with Cyprus, we have a very favorable tax residency where you can obtain tax residency in as little as 2 months thanks to the non-dom regime, which requires that you have a long-term lease or own property, have economic activity in the country, which translates to owning a company, spend 60 days inside Cyprus and ensure that no other country considers you a tax resident. Once all this is done, you can obtain your tax residency certificate and disconnect from your aggressive country. It's especially good for EU citizens as they can obtain the yellow slip, which is much easier than the pink slip. The pink slip is a temporary residency of 1 year, renewable, and this is obtained by non-EU citizens. The pink slip is a temporary residency of 1 year, renewable, and is the one obtained by non-EU citizens. Truthfully, as a freelancer in Cyprus, it is not particularly worthwhile, although approximately the first 21,000 euros, previously it was 19,500 euros, are exempt from income tax at 0%, but you still to pay social security. If I remember correctly, in Cyprus nowadays, social security payments are made quarterly, amounting to 20.4% of the freelance estimate income, 16.4% social security, and 4% of GESI. In principle, Social Security will determine how much you should pay each quarter based on your estimate professional activity. However, it is possible to carry out a simple procedure that allows paying this percentage based on your actual income. To give you an idea, the minimum contribution is around 190 euros per month. Now, if you move to Cyprus, it makes no sense to be a freelance. For that, it would be better to go to Bulgaria, to Romania. What makes sense in Cyprus is to be a business owner either with a local company or a foreign one. Locally, you have a corporate tax of 12.5%, which they are considering raising to 15% to match the EU's minimum standard. Alternatively, you could use offshore companies taking advantage of Cyprus CFC rules. However, you cannot have effective management or a permanent establishment in Cyprus with the offshore company, but it can operate at 0% corporate tax. Dividends are taxed at 0%, but we must mention a hidden tax named GESI. Any income derived from capital gains, which are also taxed at 0% or dividends, must pay a health system contribution of 2.65%. This contribution doesn't entitle you to public healthcare access. What grants you access is having a salary from your company, even a part-time one, like 500 euros monthly, which would be taxed at around 28%, while the rest of your capital stays within the company. It is important to know, as we also commented regarding the UAE, you cannot simply drain the company's money into your personal account without reporting it. It is important to know that, as we also commented regarding the UAE, you cannot simply drain the company's money into your personal account because it's a salary. In Cyprus, you cannot pay yourself an absurdly low salary when the company is making good profits just to avoid social security contribution and pensions. That would not be realistic. If you are making 10 million euros and you are the company's director and decision maker, you should pay yourself a salary that is proportionate. On the crypto side, it is interesting to mention that many people say it's 0% because Cyprus has no crypto regulations. Well, a few years ago, maybe they would have said nothing, but honestly, what I I would do if I were in Cyprus is this. If you hold crypto for over 1 year, like in Germany or Portugal, you pay 0% taxes, except for that 2.65% GESI contribution. However, if you are doing intraday trading or operations where assets are not held for 1 year, I would operate through a local or offshore company because I would not risk it being treated as a personal income tax at up 35% plus social security as a freelance. Also, it is important to mention that Cyprus has a tax treaty with the US. For example, in Cyprus, maybe you see a lot of YouTube guys because they are making YouTube automation and the royalties there at a 0% tax. So they avoid completely withholding taxes at source. What could I mention about Cyprus is that I have been tax resident there in 2024. I paid my taxes there, low taxes, less than 10%, in practice less than 10%, and was great because I was there 60 days, I was tax resident there, and I moved to another countries. Now let's move on to Malta. I just want to mention Malta briefly because we personally work with only two types of profiles there. The first, people who remain in their tax-held country all year long, have a fairly successful company, and we can set up a holding structure connecting Malta and their country because they have a tax treaty so that the tax credits are optimized very effectively. The second, people who actually reside in Malta and take advantage of the non-dom regime. However, Malta's non-dom doesn't work like Cyprus one. If you don't remit the income into Malta, you do not pay taxes on it. It is true that you have to pay certain small fees or minimum charges so the government gets something, but apart from that, we can play with offshore companies and be fine. It is understood that if you have lived in Malta for 6 months, the money has been considered remitted, so it would be smart to register that money as remitted and pay taxes on it. But the rest remains at home, as I say, meaning you pay little or nothing, depending on the offshore company you choose. In non-dom countries like the UK, Malta or Thailand, many people have done things incorrectly. Instead of properly remitting funds, they paid for same-time expenses using entities like the US LLCs to avoid showing that they have brought money in and thus avoid paying taxes. However, as I said, in most cases, people who did this didn't do entirely correctly and overexploited this tax advantage. In many cases, nothing happened, but still it was risky. I mentioned Thailand because this is exactly what many people are currently doing there with a US LLC. Now let's move to Portugal. In Portugal, honestly, there is not too much left to take advantage of. Also, we have to mention that we have there the golden visa with the passport, okay, with the citizenship. But apart from that, there is a new tax scheme that is very hard to apply. There are some tax exemptions for young workers. What I mainly want to highlight about Portugal is the 0% capital gains tax on cryptocurrencies if you hold them for more than a year. This is extremely good if you have 10 million euros in Bitcoin and you have held it for 1 year, as long as you have complete traceability, meaning full documentation for every point of purchase and sale. You can take advantage of this just like in Germany. However, do not try to cash out crypto legally at 0% in Europe without having all your entry and exit points properly documented, because if you are audited and you can't prove it, you will be in a serious trouble. Previously, under the NHR 1.0, okay, non-habitual resident regime, you could benefit from a 20% flat tax on income tax, which was not bad, but if you were self-employed, the first year you paid no social security, the second year you paid a little, and from the third year onward, the burden grew significantly, making it not worthwhile. On another side, many people had US LLCs done completely wrong, and whether or not they will get caught, nobody knows for sure. But considering the trend within the European Union, which doesn't look good at all, certainly many people living above their declared means in Portugal, failing to report foreign income, will eventually get caught or at least questioned. Because as we said, that 0% dividend treatment works great when you have a real company with substance and effective management abroad, like a company in Bulgaria takes at 10% or in Cyprus at 12.5%, with a local director on payroll, but not with a simple US LLC with no real presence in the US, where your only protection is the privacy of registration and hoping they will not ask any questions. However, if there is even the slightest clue, they can start investigating and you won't be able to justify it. Now let's move to Andorra, the most talked about option for years due to its proximity to Spain and France. As we already know, in Andorra you can legally pay between 0 and 10%, whether through personal income tax with brackets of 0, 5, and 10%, or through corporate tax and dividends from offshore companies, since local dividends are exempt. Although many people would like to go there, the €50,000 bond deposit is a big obstacle for many. It is worth mentioning that until this year, many people avoided the deposit by getting hired by a local company, obtaining a temporary residency permit, and later setting up their own company. However, I believe that from this year onward, there are many changes under the new Omnibus law. It is also interesting to know that individuals under 30 years of age pay a reduced freelance contribution, although it is not as low as in other European countries. Now we move on to Bulgaria and Romania, two countries that are very good for freelancers because they offer a flat tax of 10% on personal income, meaning income tax where you only pay 10% plus the social security contribution. In Bulgaria, you also have a 10% corporate tax and a 5% dividend tax, along with notable CFC rules. In Romania, there is the micro-enterprise regime and a small business regime, which as of this year are becoming more and more restricted. What many people do in these types of countries with low or non-existent personal income taxes and where transparent structures like UK LLPs or US LLCs are seen as transparent for tax purposes is to pay that 10% on profits, operate as freelancers paying the corresponding social security, but have limited liability thanks to the use of such an entity. In Albania, from what I have heard, there are some individuals who decide to register as freelancers there because there is a personal income tax exemption along with social security around 15% with limits. So you will end up paying taxes only on the first €120,000 if I remember correctly. As I said, it is not something we have deeply explored because we don't work directly in Albania. At most, we have looked into investment, but that's about it. Whoever finds appealing should take a closer look and let us know in the comments and we can analyze it. Now moving on to the UK, where we have bad news this year, they are abolishing the non-dom regime. Previously, if you didn't remit foreign income into the UK, you didn't pay taxes on it. This allowed people to live there without paying taxes on what they generate abroad. It is true that you had to pay some fees, as in Malta, but you could use offshore companies and keep dividend distribution at 0% if you didn't bring the money into the country. Starting from April 6, 2025, new residents in the UK who had not been UK tax residents during the previous 10 years can benefit from a special regime during their first 4 years of residence, under which they will have total exemption from taxation. For example, no taxes on income and capital gains generated outside the UK during that period. However, tax protection for trusts established by non-dom individuals will be abolished, meaning that income and gains within such trusts will be taxable if the settlor becomes a UK tax resident. Still, the United Kingdom offers fairly good CFC rules. As long as you have real substance in the origin country, you can legally benefit from poor 0% taxation. Now moving on to Switzerland. In Switzerland, there are various paths depending on the resident's profile and their economic activity. For large fortunes who do not work inside Switzerland, the famous forfeit fiscal system is still in place. This regime allows foreign citizens residing in Switzerland to pay taxes based on their living expenses instead of their living income or global wealth. It is available exclusively to those who don't perform economic activities within Switzerland, and it is not available to Swiss citizens. To qualify, you must negotiate individually with the canton where you intend to live. The taxable base is calculated based on a minimum expenditure, generally multiplied between 5 and 7 times depending on the canton. Cantons like Genova continue to offer this regime in 2025, though under stricter international scrutiny. Regarding corporate taxes, Switzerland maintains a 3-tier system. The federal corporate tax rate is 8.5%, and when combined with the cantonal and municipal taxes, the overall effective rate in 2025 ranges from 11.9% to 21%, depending on the canton. Additionally, from 2025 onward, Switzerland applies a global minimum tax rate of 15% for companies with revenues exceeding 750 million euros, in line with OECD guidelines. At the level of CFC rules, Switzerland is manageable. You can do interesting things and achieve lower effective tax rates provided you have real economic substance in the country, effective management, and so forth. For individuals, the income tax is progressive and varies greatly depending on the canton, with Zug and Swiss among the most attractive because of their low taxes. However, it is not 0% or closer, like in other countries. You will end up paying approximately 5 to 10% in social security contributions, and income tax itself can be relatively high. As for capital gains taxes for individuals, Switzerland still doesn't tax private capital gains as long as it's not habitual commercial activity. Regarding cryptocurrencies, the same. Switzerland remains one of the most favorable environments in the world. Crypto must only be declared as part of your taxable wealth, and wealth tax rates depending on the canton. We have to mention that we have some real connections in banks in Switzerland. They are too good for some people to cash out crypto, maybe 1 million, maybe 10 million, maybe 50 million in BTC into USD or into Euro or into Swiss francs. In 2025, Monaco remains one of the most attractive tax destinations in the world for high net worth individuals, top-level entrepreneurs, and profiles seeking privacy, security, and an insane financial environment. Its main attraction is the absence of personal income tax for individuals, making it a legal tax haven for those who manage to establish effective residency there. Monaco doesn't tax the personal income tax of its residents except for French citizens who, under a bilateral agreement between France and Monaco, remain subject to French income tax even if living in the Principality. For everyone else, Spaniards, Italians, Germans, Latin Americans, Pakistanis, Indians, and so forth, no tax is levied on income, whether local or foreign. This includes salaries, dividends, real estate income, capital gains, and other sources of personal income. There is also no wealth tax and no inheritance tax on direct line like parents to children. However, establishing tax residency in Monaco requires meeting strict requirements. The applicant must reside at least 6 months and 1 day per year within the territory, over 183 days rule, okay? They must demonstrate financial solvency and have suitable housing, either own or rent. In practice, this means renting a property with at least 1 bedroom per resident with a minimum 1 year lease contract. They must also deposit in a bank an initial amount that typically ranges from 500,000 to 1 million euros as proof of funds. A rigorous background verification and in-person interview with Monaco's securities authorities are also required. As for companies, the case in Monaco is very different. There is a corporate income tax, but only for companies that earn more than 25% of their revenue outside Monaco. These companies are taxed at a rate of 25% on profits. Companies operating exclusively within Monaco, such as restaurants, local shops, or internal service businesses, are exempt. There are no CFC rules in Monaco, as it is not part of the OECD or the European Union, and it does not automatically apply rules on controlling foreign entities. However, Monaco has few double tax treaties, so to avoid tax problem, it is crucial to demonstrate real and effective disconnection from your country of origin and true connection to Monaco. This includes, besides living there, relocating your economic center there, medical service there, banking, and social life. We have recently discussed this with a client who lives permanently in Monaco, works there, but owns properties in Spain. In his case, it is crucial that neither his income nor his wealth is greater in Spain than in Monaco in absolute value. Otherwise, he could face double taxation. In Monaco, you can pay 0% taxes practically of everything. However, it is important to comply with anti-money laundering regulations when banking those assets. Although their banks are highly private, they are extremely cautious and conservative, requiring full traceability of their funds' origin. As you can see, Monaco is probably one of the best real tax refuges still existing in Western Europe, but it has a very high entry price, easier to overcome than in countries with similar advantages. Thus it is ideal for high net worth individuals who seek a near total tax-free environment, provided they are truly willing to reside there, maintain a high standard of living in the Principality, and bank their capital with maximum transparency. It is not suitable for small entrepreneurs, digital freelancers, or medium-income profiles because the cost of living and entry requirements are very high. Luxembourg is a European hub for wealth structuring with favorable treatment for dividends, royalties, and fund management. It is primarily used by entrepreneurs handling investment structures, funds, SICAVs, or holdings. It is not useful for freelancers or nomad profiles. Luxembourg is highly controlled and expensive to live in. Favorable tax deals are often negotiated directly with the tax administration, especially for companies willing to locate their headquarters there. Personally, what we like most about Luxembourg is its banking sector. We have federal contactors, both in traditional banks and digital banks, who handle onboarding for certain types of companies, jurisdiction, and risk profiles. Now we move on to Estonia. Personally, I'm not very favorable towards setting up anything there unless you want to live in Estonia. The taxes you pay are well reflected in the education, healthcare, and public services you receive, but you are neither paying 0% taxes nor engaging in miraculous structures and some people falsely advertise it. Starting January 1st, 2025, the personal income tax rate in Estonia will increase from 20% to 22%. This rate applies uniformly to all personal income without progressive scales. Social security contributions are not low, but at least, as I mentioned, you see the quality of public services you are funding. It is true that Estonia pioneered the e-residency or digital residency system, but be careful, this is not a real resident permit like in Paraguay or Mexico. It merely allows you to operate an private limited company without living there. Estonia also has a unique system where the company does not pay taxes on retained earnings. Corporate tax is only levied when dividends are distributed. However, starting in 2025, the general corporate tax will increase from 20% to 22%, and the previously existing 14% reduced tax and the previously existing 14% reduced rate for regular dividends will be abolished. Bye Estonia, let's move to Georgia. Although Georgia no longer has banking secrecy due to its participation into the CRS, it is worth mentioning the ease of opening bank accounts there simply by presenting a passport and explaining where the money comes from, regardless of your situation, regardless of your current location. Personally, I have an account at Bank of Georgia and also access the premium service at Solobank, where they issue you an American Express Platinum card the same day. From a tax standpoint, Georgia maintains an attractive system for individuals and companies. Flat tax rates, an absence of complex tax regulations, and a territorial system where foreign source income is taxed at 0%. For local income, or if you repatriate income or you work from there, you pay an effective 1% tax on your turnover. If you exceed around 500,000 lari, approximately 170,000 US dollars, more or less, if I remember well, the rate moves to 3% for 2 years. The beauty is that you can have an offshore company at 0%, have real substance outside Georgia, and generate millions paying zero taxes. Locally, unless you access special regimes, there are no massive advantages. However, it is important to note that you must stay more than 183 days over 12 months to be considered a tax resident. That said, I have seen cases where even without staying the full 183 days, individuals have been deemed residents simply for paying some local taxes. Something similar to Paraguay, but not as reliable for obtaining a tax residency certificate as Paraguay is. Now, for all Spaniards watching this video, or people that like being in summer in Marbella, Malaga, my city, Barcelona, or Valencia, just as we have advantages when moving abroad, foreigners or Spaniards who have lived abroad for some time also has advantages when moving to Spain. This is known as the famous Beckham law continues to be an attractive tool for foreign professionals moving to Spain for work reasons. To qualify, you must not have been a Spanish tax resident during the previous 5 years. The move must occur under specific circumstances like employment contract in Spain, appointment as director of an entity without significant shareholding, undertaking officially recognized entrepreneurial activities, providing highly qualified professional service to startups or engaging R&D activities. If you have this allows exclusive taxation on Spanish source income, not on foreign source income. Flat 24% tax on the first 600,000 euros of annual income. The sex is taxed at 47%. Exception for declaring foreign assets, no obligation to file Modelo 720 in Spanish. Capital gains tax between 19 and 17%, but only capital gains in Spain. Capital gains tax between 19 and 26% just of the Spanish assets. Wealth tax only applies to assets located in Spain. The special regime applies for 6 years, the year you become a tax resident, plus the following 5 years. After that, welcome to the tax hell you initially escaped from, where I escaped, okay? Still, many people prefer to come back home or make Spain their new home. These are the main tax residencies you can consider in Europe. I have not mentioned the Czech Republic because while it can be favorable in some respects, it is not in others. Still, it may be an option for some. Now, if you want to flee Europe fiscally towards another region because you no longer trust this continent, I invite you to check out the best tax residencies in America or Asia available on the channel. And if you need help setting up your tax strategy, crypto banking, or obtaining a second passport, I invite you to fill out the form and we will be delighted to assist you.